Okay, so today's video is on a review of the homework. So I'm going to do here is go over discussion questions, numbers 2, 3, 4, 6, 8, and 9. And I've already done problems 2, 3, and 4 in the previous video. So I'm going to go over problems number 5 and 6 in this video. Here we go. Number 2, why is the banking system in the United States referred to as a fractional reserve system? What's the role of deposit insurance in a fractional reserve system? Your answer should indicate that a bank has only a limited amount, only a percentage, relatively small percentage of the actual deposits of its customers on the shelf, in the vault, in reserve. Or in the United States, its reserves, many of its reserves are on deposit with the Federal Reserve for the district that it is in. So on the board behind me here, typical bank, the assets, the bank has reserves, cash on hand of $20,000. Let's say there's no Federal Reserve involved in this. It's just the bank keeps its reserves in cash in its vault. But there's demand deposits, checkable deposits of $100,000. Only 20% of that $100,000 is actually in the bank. The rest of it has been given out in loans. The bank has receivables, accounts receivable, loans that it has that people owe back to the bank of $80,000. So the balance sheet balances $100,000 of assets and $100,000 of liabilities. There's no net worth to the owners in this particular bank. And that's the fractional reserve banking system. All right. What is the role of deposit insurance? If all these people went to withdraw their money from the bank and wanted it in cash, the bank would not have all that cash. Thus, we have this system of deposit insurance in the United States if there are ever runs on the bank. We haven't had the kind of runs that they had back in the 1800s and the early 1900s in a long, long time. The last time we had massive runs on a bank was in 1929, 1930, 1931, during the crash and the Great Depression. In the crises that happened in the 1980s and again in the early 2000s, we didn't have runs on the bank the way we did back in 1930s. So the deposit insurance was used in the 2008 crisis, but wasn't a big problem. All right, number 3. What's the difference between an asset and a liability on a bank's balance sheet? How does net worth relate to each? So assets are cash on hand, loans that are accounts payable to the bank, accounts receivable rather for the bank, and securities that would be on the asset side also. Remember that when we say securities, we mean the bank's ownership of U.S. bonds, corporate bonds, instruments, investments that the bank has that are earning it interest. Those are the securities. And then the liabilities on the right-hand side. So let's say that this bank has securities of, say, another $20,000. So now the left-hand side adds up to $120,000. On the right-hand side, it's only got liabilities, demand deposits of $100,000. So there must be net worth of $20,000 in this bank. So net worth is the assets minus the liabilities equals the net worth. Number 4, why does the Federal Reserve require commercial banks to have reserves? So remember the history of banking video where I talked about the fact that in the 1800s, early 1800s, there were some very unscrupulous banks, wildcat banking era. Remember that? Where the bankers would lend out all or even more than their, all of their deposits. They couldn't lend out more than their deposits, but they could lend out virtually all of their deposits and only have maybe 1%, 2% on the shelf in the vault. And that was a recipe for disaster. When people did go just to withdraw reasonable amounts of money from their bank account, the bank would say, we don't have enough in the vault. That would cause panic and create a run on the bank. So one reason for requiring reserves is to make sure that banks have some reserves in the vault. But that's not the primary reason. The primary reason is to limit the amount of money that the bank can create in loans. And that way the Fed has some control over the size of the money supply. Because remember, the money supply is not just the currency that the Treasury Department has printed or minted in coins. It's also all these outstanding loans that banks have given to their customers that created new money. So requiring banks to have a certain percentage reserve of required reserves limits the size of the money supply. Explain why reserves are an asset to commercial banks, but a liability to the Federal Reserve. So the reserves are cash on hand for the bank. That's their asset that they can invest, give loans, buy securities, whatever they want to. When the bank deposits some or most of its reserves with the Federal Reserve System, which is above and overseeing the private banks, the Federal Reserve System owes that money, those reserves, back to the bank, so it's a liability for the Federal Reserve Bank. What are excess reserves? So let's say that this bank, let's say it exists in a banking system, a Federal Reserve System, that requires it to only have 10% reserve requirement. So 10% of 100,000 would be $10,000. This bank would then have excess reserves of another 10,000. 10,000 required reserves. It has 20,000, so 10,000 of the 20 are excess reserves. And that's the amount that they can lend out to new customers. How do you calculate the amount of excess reserves held by a bank? It's the required reserve, actual reserves minus required reserves equal excess reserves. How do you calculate the amount of excess? Okay, what is the significance of excess reserves? That's the amount that they can lend out to new customers. Number 6, when a commercial bank makes loans, it creates money. So when this bank gave these $80,000 of loans out, it created new money that didn't previously exist. A lot of these demand deposits of 100,000 are probably because of the loans that this bank has given out in previous days or weeks or months. And when loans are repaid, money is destroyed. So as customers make their monthly payments on their loans or a lump sum payoff, the loan is destroyed. Demand deposits go down. Let's say one of the customers makes a $20,000 payment on his loans. Demand deposits would go down to 80,000. The loans, 20,000 is paid off. That would go down to 60,000, and the bank would still be in balance. But now the money supply is down to only $80,000. 20,000 was paid off. It destroyed that amount of money, so to speak. Okay. All right. Number 8, explain why a single commercial bank can safely lend out only an amount equal to its excess reserves. So let's say that required reserves are 10,000 for this bank. It's got 10,000 in excess reserves. That's all it can lend out, because when it lends that $10,000 out, people are going to take that money and spend it. They're going to buy the car or buy the refrigerator that they borrowed the money for. So checks are going to be written, and the bank is going to lose demand deposits. Its required reserves are just going to barely cover the amount of checking accounts that the demand deposits that they have. So the individual bank can only lend out the amount of its excess reserves. The system, as I explained in the previous video, can lend out a multiple of those excess reserves. And that's what the money multiplier is all about. If excess reserves are $10,000, the system as a whole can lend out 10 times that, because the reserve required reserve ratio is only 10%. So 1 over 10%, which is 0.1, is 10. The money multiplier is 10. The system itself can lend out 10 times that amount of excess reserves. Number 9, how would a decrease in the reserve ratio, in the reserve requirement, affect the size of the money multiplier? So if we decrease this to just 5%, that would be 0.05. So let's say we go from 10% to a 5% reserve requirement. 0.05 goes into 1 20 times. So lowering the reserve requirement would increase the money multiplier. Money multiplier would increase. Lowering the reserve requirement would increase the money multiplier, and raising the reserve requirement would lower the money multiplier. The amount of excess reserves, if you lowered the reserve requirement, excess reserves would increase. And C, the extent to which the system could expand the money supply through the creation of checkable deposits via loans would increase. Okay, all right. So I'm going to pause it here because I need to get it set up for the problems.